Morning, everyone. Welcome to this press briefing on Asia and Pacific region. And thank you for being with us here today early in the morning. And also welcome to those who are watching us online. My name is Ting Yan. I'm with the Communications Department. And let me introduce our speakers today. Sitting in the middle is Mr. Changyong Ri, Director of the Asia and Pacific Department. And we also have 4 deputy directors here. On Changyong's left, we have Mr. Ken Kang and Mr. Jonathan Austrie. On Changyong's right, we have Ms. Anne-Marie Gold-Wolf and Mr. Otpech Brack. So Changyong will have some opening remarks, and then we'll be happy to take your questions after that. With that, let me give the floor to Changyong.
Thank you, Ting. Good morning. We are very pleased to share with you our views on the economic outlook for the Asia-Pacific region. Let me start by summarizing our main message. First, despite the faster than expected slowdown of global economy, the outlook for Asia-Pacific region remains relatively stable. The region continues to account for more than 60% of the global growth, but downside risks have increased, including faster than expected deceleration in global growth and trade, the possibility of renewed trade tension, higher oil prices, and global financial market volatility. Therefore, it is a little bit still too early to say that spring has come in the region. Policies and reforms should seek to maintain the current expansion while ensuring sustainability and increasing resilience. Let me expand on this point, starting with the economic outlook for the Asia-Pacific. As Managing Director Lagarde said at her press conference yesterday, the world economy has been slowing more quickly than expected. However, economies in Asia has remained resilient due to 3 contributing factors compared with the situation in last October. A pause in interest rate normalization in major advanced economies, the U.S.-China trade truce, and the lower commodity prices contribute to the in stabilizing Asian economy. In addition, several countries have eased their policy stance in response to global growth slowdown. Considering these factors, we project Asia to grow by 5.4% both in 2019 and 2020, largely unchanged from our projection from last October. In China, you may find surprising that we revised up our 2019 growth projection to 6.3% from 6.2% in October, mainly due to the change in our assumption that the U.S. tariff rate of 10% on 200 billion packages will not rise to 25%, which was assumed in last October that the rate will increase from March, but due to the tariff truce, the tariff increase, we are assuming no longer the tariff will increase. And also the larger than expected fiscal policy response from Chinese authorities will also help offset the impact of weaker external demand. As a result, we revised overall China's growth rate by 0.1%. In Japan, the economy is projected to expand by 1% in 2019. This reflects additional fiscal support this year, including measures to mitigate the impact of planned consumption tax increase in October 2019. In fact, Japan is the only G7 country where growth rate in 2019 is expected to be higher than in 2018. In India, growth is expected to pick up to 7.3% this fiscal year amid more expansionary policy stance. And India remains globally the fastest growing large economy. We keep the growth forecast for Korea at 2.6% this year, despite weaker investment and export, as we factor in substantial stimulus from the supplementary budget, which was announced by the government. In Australia and New Zealand, growth in 2019 is projected to slow to 2.1% and 2.4% respectively, reflecting weakening domestic demand, continued cooling of the housing market, and the weaker global economic outlook. In ASEAN, growth is projected to remain broadly stable at around 5% in the next 2 years, despite less favorable external demand environment because of the more domestic demand, domestic factors contributing to the resilience in the Asian economy. Growth in Pacific Island countries and other small states is expected to recover after several natural disasters last year, with significant variation among countries. So now let's move to discuss risks in the region in looking forward. Overall, risks are tilted decisively to downside. First, we are watching closely the deceleration in global growth and trade, and if the trade deceleration turns out to be more pronounced and long-lasting, that will clearly affect growth in Asia-Pacific region. Second, trade policy uncertainties could pose a renewed threat to growth. A trade deal between the US and China is still quite uncertain, and if the agreement is reached, that will definitely be beneficial, as lower tariff, reduced uncertainty, and structural reform in China would support global growth. Financial markets have already responded positively to this possibility, so that any setbacks in the negotiation could constitute downside market risk. In case of agreement, still, involving managed trade, where China commit to import more from US by reducing import from elsewhere, can be an issue. There could be a negative impact on other countries whose export to China would be crowded out by US export. Likewise, if the deal involved preferential access for the US to Chinese market, this could lead to broader worries about the future of the multilateral trade system. Third, global financial conditions could tighten if downside risk materialized and financial market entered a generalized risk-off episode. Tighter financial condition would definitely affect disproportionately countries with higher private or public sector financial leverage. So, given this outlook, let me conclude by discussing our major policy recommendation. As I explained, we see several headwinds emerging from unfolding slowdown in global growth and trade, which will keep conjuncture quite challenging. By contrast, there are tailwinds also from the pause in advanced economies' monetary policy normalization, lower commodity price, even though the oil price start to increase again, and some policy stimulus in the region. In addition, crosswind from trade tensions are continuing, adding the currently heightened uncertainties. Therefore, agility, vigilance, and prudence will necessary to navigate through these swirling winds. Macroeconomic policies should aim at stabilizing growth while ensuring sustainability and increasing resilience. In parallel, financial policies should aim to address vulnerabilities from high leverages and build up buffers. As many Asian economies has policy space, if downside risk materialize, Asian policymakers need to adjust their policies depending on countries' specific circumstances. Asia also needs to focus on policies to sustain its growth momentum over the medium term in the face of declining productivity growth and rapid aging. Labor and product market reforms, as well as further market opening, should continue with a view to boosting employment, firm dynamism, and innovation, while at the same time strengthening social spending to address rising inequality and inclusion to address rising inequality and inclusion gaps. So that summarizes our economic outlook and policy recommendation. Thank you, and let's turn to your questions.
Thank you, Chang-Yong. Now we can take your questions. Please identify yourself with your name and media organization, and we'll take a few questions together. This gentleman in the second row here.
Thank you, Ting. Thank you, panelists. I would like to, Wang Guan with CCTV and CGTN America. My question is, what substance do you hope to see, or would you recommend to be included in a potential US-China trade deal so that it will most likely benefit the Asia-Pacific region? And secondly, if you can comment on China's stimulus measures and how it ties in with China's long-term objective of restructuring its economy? Thank you.
Thank you. Let's take a couple of more. Yes, Taixing.
I'm Malin Xiong with Xinhua News Agency. I have two questions. Firstly, you mentioned about trade deceleration and some of the trade policy uncertainty. I was wondering whether a potential regional comprehensive economic partnership agreement would somewhat offset that kind of trade uncertainty, and what do you think such an agreement could mean for regional economic growth? Secondly, I want to ask about Belt and Road Forum for International Cooperation later this month. What's your expectation for the forum, and what does the IMF wants to bring and maybe bring out of the meeting? Any kind of agreement or potential cooperation under that frame? Thank you.
Thank you. And the gentleman here.
Hi, I'm Indika from Sri Lanka. Could you comment on any fiscal slippage risks that Sri Lanka might have given this is an election year? The other question is, how important is labor reforms given the aging population in Sri Lanka?
I think probably we have to answer before we forgot the questions. Okay, I'll address this trade talk in a more general way, and then I will ask Ken to address China's stimulus and Anne-Marie to Sri Lanka issues. First of all, let's move back. What happened last year in terms of the trade tension? What is impact on Asia overall last year? Surprisingly, impact on trade tension, which was escalated last year, didn't affect the Asia's trade flow very much until October. I mean that the real market, partly because of front loading by expecting the higher tariff, probably China maybe export in advance before the tariff increase. But also there is some trade diversion of a higher tariff on China's export goods, make some countries can benefit by for example, Bangladesh textile industry now can compete better with the Chinese in U.S. market, that kind of things. So with trade diversion and some front loading, and actually Asia, including China's trade, hold up quite robustly until November, until third quarter of last year. But we actually have some concern from last quarter of last year, and especially first quarter of this year. The Asia's, including China's trade, shows some sharp decline. Okay, so our general view is that the trade tension actually has a negative impact on Asia's mostly last year through the financial market, stock market decline, and confidence actually decline, investment decline, rather than trade flow directly. But as trade tension escalate more, now we are starting to see that the trade flow may be affected. But from January on, there is a market sentiment that some agreement will be reached by June, whatever. So the market actually so far took it quite positively. So what we are worrying about is two things. If there is no agreement reached, contrary to the market expectation, market can react quite negatively, significantly, because they already factor in some agreement will be reached. And then if the tariff, is really increased, then the trade volume can significantly goes down. That's what we worry about. That's the scenario that we worry about it. So to the question, what we are expecting for the agreement in detail, we have to wait. We don't know the answers, but as we mentioned, few things will be important. I think that probably the confirmation that tariff will not increase or even better to reduce. Okay, and then this agreement should be not a short-term agreement. Then it gives us some kind of confidence to the market. It can be a more fundamental agreement between the China and U.S. and others. Basically, that means that the structural issues that has been discussed, such as fair trade and the intellectual property and the structural side or more market opening, those things has to be an important element. That otherwise, this this agreement may be short-lived. So, kind of longer-lasting agreement will be very important. And we have to wait. But also the last point, as I mentioned, there should be the agreement should be consistent with multilateralism rather than bilateral agreement between U.S. and China. Okay, that's our view on the trade. And can you want to say the stimulus?
Yeah, on your question about Chinese stimulus and restructuring, as Changyan mentioned, the modest slowdown in growth in China is broadly in line with our expectations, reflecting mainly the authorities' efforts to rein in excessive credit growth, but also the escalation of trade tensions. And the authorities have responded appropriately to the spillovers from the trade tensions by easing policies. On fiscal policy, I think we support the focus of the budget on boosting consumption by reducing the high levels of Social Security contribution rates and by reducing the dispersion of VAT, which will help to boost consumption and jobs. At the same time, there is a need, though, to look for ways to make the tax system more progressive, as well as to boost spending on pension, education, and health. From monetary policy, our view is that the degree of monetary accommodation is sufficient. The PBC cut the reserve requirement rate several times last year, and as a result, interest rates have declined. But given that we have fiscal stimulus underway, and given that inflation pressures remain low, we feel that monetary policy is at the appropriate stance and should focus on its main task of containing inflation pressures. On your question about restructuring, I think, in our view, the overarching policy imperative remains to switch to achieving high-quality growth from high-speed growth. And basically, that means to accelerate efforts to rebalance the economy by boosting consumption, but also look for ways to open up the economy further through further reforms of investment and trade.
Yeah, let me come to your question on Sri Lanka and the context of the forthcoming elections. In that context, we really need to emphasize three messages. I mean, we need to make sure that the authorities should continue to pursue prudent policy mix in the run-up with sustained revenue-based fiscal consolidation, an adequate vigilant monetary policy, and continuing efforts to build reserves. It is critical in this context that market confidence is being maintained and the economy's resilience to shocks, which has been strengthened over the past couple of months, continues to be strengthened. As you know, there is high public debt, so market confidence is a critical element. Structural reforms are ongoing. They need to focus on trade opening, SOE reforms, and increasing competitiveness. And you mentioned the issue of labor. At this point, as you know, unemployment is low, but in the forward-looking policies of competitiveness and looking at an aging population, labor reforms are essential. One of them that I would stress is increasing the participation rate of women also, which is very low in Sri Lanka. Thank you.
All right. Yes. Okay, I'll take the question on the BRI. I think we see the China's Belt and Road Initiative as an important one for fostering greater regional economic cooperation, particularly in the areas of trade, investment, and finance. This will give a boost to much-needed infrastructure, investment, and connectivity, which in turn will support trade and growth. That being said, the initiative does entail risks if not managed well. Risks stemming from issues related to fiscal sustainability, limited positive spillovers to recipient countries, and even risks to China, including credit risk. Therefore, it is important that these projects be implemented well. And this requires ensuring that a focus on open procurement, high standards for governance, a focus on fiscal sustainability, as well as private sector participation. We at the IMF have worked closely with the Chinese authorities on sharing best practices, including in the areas of fiscal sustainability. And we stand ready to do more to further our engagement, including through the China IMF Capacity Development Center, which was just established last year.
Thank you. Let's take a couple of more. Yes, Anup here.
This is Anup Roy from Business Standard newspaper, India. There is a lot of interest in India's bonds, particularly government bonds among foreign portfolio investors, but it is capped at 6% of the total outstanding. So do you think that at the same time India wants to be featured in some global index, Do you think that it's time that India should open up more space for that bond for the foreign investors? Also, one additional question: do you think it's time that India should consider a full convertibility of the currency? Thank you.
Thank you. In the front row here. More questions? Yes, front row here.
Good morning, Jacob Grieber from the Australian Financial Review. Quick question, perhaps sort of a general one. In terms of the related to the trade negotiations between the United States and China, other things are developing, such as the new CFIUS rules that are coming into place, restricting potentially ownership of companies in America to minority owners. There are rules being discussed around exports. It's all part of worrying about the loss of technology and IP out of America. What's the view on what this does to global growth and what it does in the region? Does this lower potential growth because it's a sort of headwind? And perhaps to Mr. Austria, throw a question: does this affect a country like Australia? Are there any concerns that our investors, policymakers, should have?
Maybe we can start. Yeah.
Okay.
Yeah.
Why don't you start, Jonathan, and then go back to...
Okay.
So on the general question, I think, as Cheng Yong alluded to in his opening remarks, our main concern is that whatever deal is reached in both about trade and the surrounding opening up policies in China and so forth, be done as far as possible on a multilateral basis, respecting the multilateral rules of the system, and that we try and limit as far as possible sort of preferential access of some countries to some markets, rather than sort of respecting general multilateral rules. I think as far as the impact of the U.S.-China deal on Australia itself, I think the main issue that we worry about is possible trade diversion effects, which Cheng Yong alluded to in his opening remarks. Our sense is that we've done some, obviously, until the details of this deal are known, we can't really do more than sort of analyze a hypothetical case. And we've done such an exercise in which China agrees to import, say, an additional $50 billion in goods from the U.S. and sort of through the trade linkages examined the spillover effects, the possible trade diversion effects as China imports less from other countries. Our sense is that sort of the first round impact of that on Australia would be relatively small if sort of there's a proportional reduction in Chinese imports based on initial trade shares across its main trading partners. But that if the deal involves more purchases of goods in commodities that are very high in the China-Australia trading relationship, then the impact on Australian growth and so forth could be more substantial.
Yeah, let me talk to your question on India and the capital account liberalization. As we have mentioned also before, we would support a continued gradual liberalization of India's capital account, broadly in line with the plans as the government and the RBI have formulated it. This strategy needs to be well balanced, looking at financing need, but emerging external vulnerabilities and limiting vulnerabilities that are around, given the very high financing needs of the government. In the first place, when looking at capital account liberalization, we would encourage to look at FDI. This should be a priority, and then gradual opening for portfolio flows afterwards. And I think the question that you had on the full convertibility of the rupee needs to be seen in exactly the same contents. It has to be gradual, and it has to be seen against the vulnerabilities that are there. we have, the government has a medium-term fiscal strategy that looks at a limiting debt at 40%. Once you are at that level and sustainability is achieved, then that would be the right time to consider the full opening of the capital account.
Thank you. Yes, lady in red here.
Hi, I'm Soyoung Kim from Radio Free Asia. About North Korea, since North Korea has been building relationship with the U.S. and South Korea, it's been a question that if North Korea is joining global financial institutes like IMF or World Bank, and also South Korean president stated that Kim Jong-un is interested in joining those global banks. So my question is IMF willing to help North Korea join as a member? If so, what's the major requirements, or on the other words, the biggest challenge for North Korea to join those global financial institutes? Also, is there any assistance that IMF can provide, not necessarily financial aid, but something else before even North Korea becomes a member? Thank you.
Thank you. Here.
Mike Gallagher, Continuum Economics. Just a question about China more broadly and the transition from an investment and export-orientated economy towards a consumption and service-based economy. One of the key issues for Chinese growth going forward, we've had some success so far. What are the challenges in the coming years?
And yeah, the gentleman here.
Sorry, I am Siddiq Islam, representing the Financial Express, Dhaka, Bangladesh. Most of the South Asian countries, including Bangladesh, now currently formulating a mixed monetary policy covering both conventional and unconventional approach to achieve the sustainable economic growth through boosting the financial inclusion programs. How to see such initiative to minimize such initiative to facilitate the financial access to the finance, particularly the unbanked people, mainly women of the Bangladesh. Second, I'm interested to know about the financial sector of Bangladesh. Mainly the banks are now facing the huge NPL, like India, and day by day is the trend, increasing trend is the continue. What is the recommendation about the issue to resolve to minimize or to reduce the volume of NPL in the banking sector? Thank you very much.
Thank you.
Do you want to answer China, North Korea?
So I'll take the question on North Korea first. On North Korea, we have not received any communication from North Korean authorities regarding possible engagement with the IMF. As you know, North Korea is not a member of the IMF, and therefore we cannot provide financial assistance. More broadly, whether any engagement, whether it's financial or non-financial, would very much depend on the views of our major shareholders and the executive board of the IMF. On the question about China's transition and the policy challenges, as I mentioned earlier, it is our view it's important for the Chinese authorities to stay the course, to continue with efforts to switch to high-quality growth from high-speed growth. And basically that entails four broad elements. First is to continue with deleveraging, through a tightening of regulatory and financial policies. Second is to look to expand the role of the private sector through a further opening up of trade and investment. Third, as you mentioned, is to boost consumption while slowing the pace of investment. And lastly, over the longer term, look for ways to modernize the policy frameworks, including fiscal, financial, monetary, as well as on policy communications. It's important to accelerate these efforts to rebalance and to continue with de-risking, because this will help make the Chinese economy achieve a more sustainable path of growth, as well as reduce vulnerabilities for the benefit of China as well as for the rest of the world.
Can I take the question on the banking sector in Bangladesh? You know, you point your finger to an important question. We see a need to address banking sector issues very urgently. Bank performance in Bangladesh, in spite of strong economic performance, has not been satisfactory. We have seen an increase in non-performing loans, both in the state-owned banking sector, but there are issues also in the private sector. So the authorities have started taking on efforts to improve supervision, regulation, and we will have what we call a financial sector stability review forthcoming for Bangladesh, in which we will discuss with the authorities very concrete steps on what they can do to strengthen the banking sector. You also made the right questions about financial inclusion. This is an important element in the private sector development, and there are issues in Bangladesh, even though Bangladesh was a pioneer in microfinance. So looking at those issues will be a big part of this financial sector assessment review that's going forward.
Let me take a few questions online. We have a question from Bloomberg News Indonesia. He has two questions. One is, a few months ago, during the meetings in Bali, trade tensions and the Federal Reserve's policy normalization path were key risks for emerging markets economies, including across Asia. What are the key risks facing Asia at this point, and are they now start winding back rate hikes that were made in response to the Fed's tightening? And the second question, we have seen in recent months inflation trending down in several economies in Southeast Asia. In Indonesia, it has fallen below central bank's target band of 2.5 to 4.5%. Is this overwhelmingly a good thing, or does it also present risks? If so, what are those risks? We've also got a question from Reuters New Zealand. What is the outlook for New Zealand's economy in the next year, given how dependent on trade it is, as well as some domestic drivers being quite weak in recent months? And one more question from Japan, Asahi Shimbun, on Japan's consumption tax. Given the recently released will has downgraded Japan's growth, and has Japan projected growth percent of 0.5% in 2020, and given the trade risks, is there a scenario where the IMF would not support a rise in the consumption tax?
Okay, let me take the first question about Indonesia, and I'll ask Otpel to answer the second and the Japan one, and then Jonathan can address the New Zealand one. As I mentioned, that I think in ASEAN countries and also India, actually government authorities did a great job in handling the financial turmoil in last October, when the oil price is rising and there is a depreciation pressure in Asia, and the Fed start to normalize it. So that risk is much reduced now. So as a question asked, whether this is time for them to start to reduce the interest rate and focus more on other policy objectives. My answer is two things. One, definitely this current environment allow them more policy space. It's true. They have now, compared with the last October, they have more room to use several policy options for enhancing the growth and or some financial stability. But at the same time, as we mentioned, the downside risk is higher now. Still remains. For example, like trade tension, even though it's a lot less so, but still there's lots of uncertainty whether the deal will be reached or not. And then also that the global economy is also slowing down. So given this opportunity, these uncertainties, I think that still is important for Asian policymakers a little bit to be not to be complacent and still look at how the things will go, and then try to save the ammunition in general. But definitely, if the downside risk materialize, they have a space to react.
Thank you. So I'll comment on inflation in Indonesia. First off, low and stable inflation is a good thing. It protects consumers' purchasing power. It facilitates long-term planning, and it's In that sense, it's conducive to sustainable economic growth. It's also good social policy in the sense that poor people tend to be affected more by high and unstable inflation. Now, in Indonesia, the CPI inflation did indeed decline from 3.1% at the end of last year to 2.4% in March, the latest numbers we have. The main driver behind this was food prices, and the core inflation, excluding food prices and other volatile prices, was basically unchanged at around 3%. Now, what does this mean for monetary policy in Indonesia? Those who follow Indonesia may recall that Bank Indonesia raised interest rates in several steps by 175 basis points in the course of last year. Many was faced or more affected by the emerging market sell-off than other countries in the region. Following this, it has kept the interest rate policy rate on hold. We think that this stance is appropriate at this point, but going forward, we think that Bank Indonesia should monitor the effects of the steps that it's already taken and see how it affects inflation over time, and if inflation is coming down, stand ready to loosen monetary policy. On Japan, on the consumption tax increase, I think the one thing to keep in mind is that it's inevitable that taxes in Japan have to go up over time. This is needed to help manage the debt position. Japan's debt is very high. And also it's important because Japan will be facing increasing spending pressures as a result of the aging population over time. Relying on increases in the consumption tax to do this is a good way, it's an efficient way, it's equitable, it's less distorted than other taxes. And even at 10%, which is the planned increase, the plan is to increase the consumption tax rate from 8 to 10% in October. Even at 10%, the rate is very low by international standards. So that's the first point. Now, the second point is it is also essential to protect near-term reflation and growth while increasing the consumption tax. And with this in mind, we have recommended that Japan keeps or introduces offsetting measures to keep fiscal policy impulse unchanged from 2019 and in 2020. In late 2018, the government introduced a set of measures to offset the consumption tax increase, which means that the stance for this year is neutral. But on current policies in 2020, there will be a fiscal contraction of about 0.5%. Let me maybe comment very briefly also on the longer term. Beyond the short run, a growth-friendly fiscal consolidation strategy would be needed in Japan. And this has to include further increases and gradual increases in the consumption tax and to levels that are about 10%. And then combined with concrete measures to deal with the spending implications of the aging population. Defining and announcing such a plan now can build fiscal space even in the short run. Now, on the last point, should downside risks materialize, for instance, as a result of trade tensions, the authorities will have to look at measures to provide additional support to domestic demand. In that case, we think that fiscal policy should be the first line of defense, given that monetary policy already is very accommodative and that the monetary policy space is quite limited in the current situation in Japan. But a delay in the consumption tax should not be part of the short-term stimulus. Rather, what Japan should pursue is well-targeted supplemental spending focused on areas that can boost growth and achieve social objectives. Thank you very much.
So indeed, we do see the outlook for New Zealand to be somewhat weaker this year than it was last year. Like many countries, there are global headwinds, and that's part of the story. But the more important aspect is that the factors that were boosting growth last year are coming off. These include reconstruction from the earthquake, sizable net immigration, and also tailwinds from the property market. These things are going a little bit into reverse this year. There are also risks around that outlook, both from domestic and external sources. On the domestic side, the property market downturn could be more severe than we currently project. The boost from fiscal policy, including infrastructure spending, could come on stream slower than we hope. And there's also the possibility, of course, from a global aspect that risk aversion and global financial conditions tighten. And given high household debt in New Zealand, that would be an amplification mechanism for domestic demand in New Zealand. That being said, as for Australia, New Zealand has considerable policy space to manage those risks, both through monetary easing and providing further fiscal stimulus.
Thank you. Let's take one last question. And the gentleman here. Yes.
Thank you. This is Sewon Lee, Yonhap News Agency from Korea. And as you mentioned, the Korean government is preparing for the supplementary budget, but the size of the budget will be much smaller than IMF suggested. Well, do you still think the Korean government will achieve the GDP growth 2.6%? If so, why do you think that? Could you tell me the reason more detail?
Yeah, just one.
Yeah, okay. Okay. On your question about Korea, I mean, we are projecting growth to moderate slightly this year to 2.6%, and that driven mainly by slowing exports related to the tech cycle, as well as a bit sluggish investment related to the maturing of the construction cycle. But on the positive side, we do expect private consumption to pick up due to the fiscal impulse already in the budget, as well as an expected supplementary budget. We continue to believe that additional stimulus is needed through a supplementary budget, and that this stimulus, this spending, should focus on ways to improve the social safety net, to improve the functioning of the labor market, and to help promote investment. At the same time, I think the spending can also be quite useful for promoting structural reforms. We take note of the need for greater what we call flexicurity in the labor market, ways to strengthen active labor market policies, but also looking at more broadly at the product market. I think further liberalization of the service sector would help, and reducing barriers to entry would help promote innovation and investment and employment in Korea.
Thank you very much. This concludes our press conference.